CFA Level I. So fixed income is one of the many modules that is in the syllabus, and we just randomly choose to start off with fixed income because before I start, Hemant, what do you know about fixed income? And you want to maybe start off by
I think fixed income is a way to earn money passively without taking too much risk. It's almost like it's a guaranteed passive income, right?
Yeah, I mean you can look at it that way, but we will start off from the perspective of the company. So it's basically a way for companies to borrow money to fund their operations. So fixed income instruments like loans and bonds are the most typical methods of financing. So the key word is financing. So you want to finance certain projects or operation like your daily business as usual operation in companies. You need the money, right? Let's think of it this way. Earlier in our podcast, the Let's Talk podcast, we actually talked about how companies raise money for their companies. So they can either issue equities, which is a share of the company, or they can just borrow money via debt. So there are two ways to borrow money. One is you can take a loan, and another one is you can issue bonds. We'll go into more details on what is the difference between the two. But both loans and bonds are considered fixed income. Issuers of fixed income instruments include businesses, governments, and non-profits, all of which commit to paying interest and repaying the borrowed principal to the investors. So as you can see, businesses are basically the companies that we were talking about. But it's not just businesses. Governments can also, government actually borrow a lot of money. Whenever we talk about treasury bills, treasury bonds, all those are borrowings from the governments, and also non-profits, even organizations that technically do not actually aim to make a profit, would also need to borrow money for their day-to-day operation. So we first talk about loans. Loans are usually agreements between individuals or companies and banks. Probably easier to just think of loans as a bank loan. For example, especially for small businesses, when you first start your business, you probably use the owner's startup equity as capital for their to start up the company. And then once you start a company, you can start borrowing money. That will always be the first step. And the borrowing money will be just by taking a bank loan. You will not be issuing bonds because bonds is very costly to issue. And also you have to pay a lot of fees to the banks, which will underwrite the loan for you, the bonds. And typically it's for bigger notional amounts. So for small businesses and startups, at the beginning, you're probably not going to borrow a lot of money because no banks will actually want to lend you that much money. And furthermore, if you issue bonds, nobody's going to buy your bonds, right? Because the fact is that you have no track record as a company. So most of the time, you start off with loans and you move on to bonds. But a lot of times, even for big companies, if the banks are able to give a attractive interest, you would also choose to borrow from the banks rather than issue bonds, because the underwriting fees for bonds can be very costly. If you are raising money for, it's not a lot of money, it might not be worth the cost, and various other factors.
So if I just need $1 million, I would just go to the bank to get a loan, right? But if I need a $100 million, I would consider issuing a bond, right? Did I understand that correctly?
Yep, you can think of it that way. I'm not really sure what like the usual cut off notional amount, but $1 million probably bank loan would suffice.
How do I buy a bond, right? Let's say Apple needs to issue a bond, right? Do I buy under a different ticker symbol, or like can common people even buy the bond?
For common people, you can buy through the brokerage accounts. You do not search for the ticker because there's no ticker, right? For bonds, they have like the IC number and the QSIP. We will show some real examples, but right now I don't have the examples in the slides because we're still just trying to introduce the definition, right? But eventually we will show you more examples.
Okay.
But right now we just move on with the definition first, because I haven't actually moved to the bonds yet. So in contrast, right, comparing loans and bonds are more standardized fixed income instruments intended to be easily traded. Oh, right. So another difference between bonds and loan is once you have a loan with the bank, you cannot trade it away. The person that is actually lending you the money, it's not like other companies or maybe individuals or anybody. It's the banks that are lending you the money. So if the banks say, I don't want the loan to be in my account books, if they are not going to be able to just trade away easily. Bonds can be traded in the secondary market. So which is one of the other distinguishing factor. And you can see here they are typically issued by larger companies, governments, and special purpose entities. But so this is the key thing is for larger companies. But these are companies and government, they are borrowing from the public, right? So the people who buy the bonds are the ones that are actually lending the money. So it could be other companies, it could be even banks, and it could be also individual traders. Okay, let's just move to the next slide. Fixed income instruments include debt instruments like loans and bonds. Peter has covered. Okay, loans are debt agreements typically formed and governed by a private contract between individual and company and a financial intermediary such as a bank. So, for example, even a company, an individual, can actually loan other companies or individual money via a loan. But most of the time, you have to go through a financial intermediary. They will draft up the contract for you, right? So that will be like the middle person. But the contract would be very specific, tailored for the particular debtor, right? Unlike the bond, which is like a more standardized version of a debt instrument, we will show later some examples of how a bond actually looks like. So bonds are more standardized agreements between larger issuers and investors. Okay, this one we also covered. Bond issuers borrow money primarily to fund operations, like I said earlier, or capital expenditures. So operations are, like day-to-day running of your company. You need the funds to run the company, right? Maybe to buy inventory or pay your wages. All these are part of the operation. Capital expenditures could be you need to buy the machine, you need to build a factory, stuff like that. You all need the funding for it. So bond investors are the ones that lend out the money by buying the bonds. So they act as lenders providing funds to the issuer in exchange for interest payment and the future repayment of the principal. So there are two components to the bond. One is the interest payment and one is the payment of the principal, which we will show in the later slides. So for subsequent example, we will use this BRWA Corporation. Start off with a T equal to 0. So the bond investor will buy the bond. So they will buy the bond, they will pass the money, and the money that they will pay will be just the principal or the par value. So for example, if it's like $1 million, the principal will be $1 million. In bond notation, we always say like 100. So par value is 100. So with the 1 million, it will be just 100. So the bond will pay to the company at T equals to 0. So the company would pay out interest, coupon payments. In this case, it's semi-annual. So they will pay out every 6 months. Depending on the interest rate, it could be a fixed interest rate. Like this, in this case, it's a fixed coupon payment. It could be a floating rate as well. We will see examples of later what it means by a floating rate. But it could be fixed or floating, is what I'm saying. And then at maturity, for example, if it's like a 10-year bond, at the 10th year, you'll pay the final coupon plus the repayment of the $1 million principal back to the investor. This is like the flow of a particular bond. Okay, so this is an example of a bond. First, we look at a title. This is the company's name, right? So it's a 5-year note, 3.2%. So this basically means that you'll pay an annual interest of 3.2%. And 5-year note means that this is a 5-year maturity bond. Why they use the word notes here is, okay, in the convention of bonds, if it's less than 10 years, it's normally referred to as a note.
Okay.
So because it's a 5-year bond, we just call it a 5-year note.
Question, the 3.2%, is it an annual interest?
Yeah, it's an annual interest. We will show more down here. So, okay, so the issuer is the Bright Wheels Automotive Corporation, the BRWA, right? This is just a fictitious company, just for illustration. So this is the company that's borrowing the money, right? They want to borrow. So in this case, the principal amount is $300 million, right? So they want to borrow $300 million USD. 5 years from settlement date. Settlement date is T plus 3 business days. You buy the bond, you have to pay the money in 3 business days. Right? This is what it means by T plus 3. And the maturity date will be exactly 5 years from the settlement date. But it needs to be in terms of it needs to be a business day. So the actual date, how you calculate the date could be quite complicated. $300 million is the amount that they want to raise, right? So the issuer will pay the investors on or before the maturity date. And the interest is a 3.26 coupon. That means your coupon, your interest will not change throughout this 5 years, right? It will be fixed at 3.2%. So on the outset, you already determine the fixed interest rate. And interest payment commencing 6 months from settlement date to be paid semi-annually with final payment on maturity date. So this is a semi-annual bond, which means that you will pay twice a year. So every 6 months, you'll get paid twice a year. So if it's 3.2%, right? So you just need to divide it by 2. So every 6 months, you'll pay 1.6%, right? So 1.6% of 300 million would be 480, right? No, 0.016, right? Times 300 million, it will be 4.8 million. Okay, another thing is this seniority. This basically means that how senior your bond is. Because the thing is, when a company goes bust, the one that has a higher seniority will get paid off first. Once they liquidate everything, they will pay off the one with the highest seniority. And for this particular note, it's unsecured and unsubordinated obligation. So it's basically pretty low in the ranking of seniority, but it's still higher than the equity shareholders. Once a company goes bust, they will pay off all the loans first. Maybe, I'm not exactly sure, but I think bank loans could be of a higher seniority than this bond.
Okay.
So they'll pay off that first before they pay off then the bond holders, and then any money left they'll pay off the shareholders.
Hey, just wondering, if I'm doing a loan, right? Like in this example here, like what's the part that is different? It seems like I can call this as a loan as well, right?
The whole idea of a bond is for companies to borrow money.
Okay.
So, and the reason why debt has a higher seniority than equity is that at most you get is the interest rate. You're not going to get anything more than what is specified here, the interest and the principal amount, right? This is what you get. But for equity, you're able to enjoy any appreciation in the share price of the company, right? Or any earnings or revenue. So for a bondholder, you're not eligible for any of this. You're only lending the company money. But at most you'll get is the interest. But if the company were to go bust, you will be first in line to get any payment upon liquidation. But for equity shareholders, you don't have that privilege, right? Most of the time, if a company goes bust, especially if it borrows a lot of money, you owe a lot of money from a lot of people. At the end of the day, after you pay off everything, you might not have much money left. Maybe you might not even have money left because you might not even have enough money to pay off the debtors. When somebody lends the company money, they don't have to worry about, all they need to worry about is whether they will get paid. And this is called a credit risk. But the last thing I want to say is the business days. So this is New York, right? So this actually just basically means that any holidays will be based on the New York calendar. For example, if it's a US Independence Day, it will be a holiday. So any coupon payment on that day, it will be the next business day. For maturity, fixed income securities with an initial maturity of 1 year or less are known as money market securities. So examples include government treasury bills and commercial paper issued by corporation. So commercial paper are short-term money market instrument that, okay, so for example, if a company, they want to borrow short-term, like maybe 60 days, 90 days, then they can issue commercial paper. They are not exactly the same as a bank loan, but it's actually a short-term loan. And for government treasury bills, like 3 months, 6 months treasury bills, all these are less than 1 year or less are known as money market. Another thing about money market is also the fact that it's actually also less risky, because your biggest risk when you're lending, when you're buying bonds, is credit risk, which is the fact that the possibility that a company might go bust and unable to pay you back. So that is a credit risk. But if the longer the maturity of the bond is, the higher will be the credit risk, right? Because, for example, you just imagine you lend a company just for 90 days versus 10 years, it will concern you more if it's the company going down for a 10-year bond rather than a 90 days money market instrument. Bonds with initial maturities longer than a year are called capital market securities. And the less common type is the perpetual bonds, which have no stated maturity. Do you know that there are in fact bonds that doesn't have a maturity? Remember the earlier example, we say it's a 10-year bond. But what if it's a bond without a maturity? What does it mean exactly?
Bonds without maturity. Does that mean I don't have to pay you back? I just forever pay you that interest.
Yeah, exactly. It's like an annuity that goes on forever. Or even you can even think of it in terms of like an equity, right? Like for equity, there is no repayment of a principal, correct? You might get dividend, but at the end of the day, you don't get something back at a maturity date. So a perpetual bond is something that pays you interest, fixed interest, forever. Initially, it's issued by public sector entities, the city, municipality. They want to build a bridge, want to build a road. They will issue like a perpetual bonds.
But what if I want the money back? Can I do that or I cannot?
Oh, you can sell. You can sell the bond to someone else.
I can sell the bond, okay.
Yeah, you can always sell the bond to someone else. The reason why even like companies now, they want to issue perpetual bonds is because they don't have to worry about paying the maturity at the end. Because the way the bond works is you pay coupon depending on the interval, right? Periodically you pay a coupon, but at the end of the period, you have to pay a lump sum back, the principal a lump sum back, which is a huge amount of money, right? So normally for companies, what they do is that they will just issue another bond to borrow the money and pay back existing bonds that are matured. They roll over the bonds. Unless they have a lot of cash from the revenue, and in the end, they didn't pay out as dividend, they can repay the bonds. But as for normal companies, as an ongoing basis company that runs like continuously running a business, they will probably just roll over their bonds.
Isn't this like a pyramid scheme if I keep on rolling over my bond?
Yeah, that's what the US government does all the time, right? They have have you heard of the US government debt is forever going up?
Yeah, I know.
Trillion of dollars, and yeah. So how do the government actually pay off these bonds? they basically just issue, the treasury will just issue more bonds, right? And yeah, but for government, it's not really, you don't have to worry about government defaulting the bonds. It's because um, they can always print money, right? I mean, in terms of the US, the government are not the one that is actually printing the money. It's the central banks, right? But the central bank can always buy the bonds from the government. They work together in the sense that, government issue bonds, the central bank can buy the bonds.
Mhm.
And government can tax taxpayers' money. So they have a way of getting money.
Mhm.
So they will never default on their own currency bonds. So, for example, a U.S. government will not default on U.S. Dollar bonds.
Mhm.
But there are certain countries, they issue bonds in US dollar, but they are not the US government. In that case, they are able to default because they are not able to print US dollar. You get what I'm saying? Like other government, they might, for example, maybe like Argentina, because their currency is because of inflation and various reasons. People don't want to buy their bonds, so they will just. Oh, a very good example is Greece, right? Many years ago, they were going bankrupt, right? Part where banks to meet regulatory capital requirements. So banks, they need to keep a certain amount of capital with them because during the '08 financial crisis, the government has to bail out a lot of these banks, right? So after the '08 financial crisis, uh, they came out with a lot of regulation. They want to make sure that banks have enough capital. So capital means that they have enough cash with them, right? Just in case if there's anything bad that's going to happen, they are able to tide off the rough period of time without the government having to bail out the banks using taxpayers' money. And one thing that they can use as capital is by issuing perpetual bonds. So perpetual bonds is one component, one way for them to meet the regulatory requirement because perpetual bonds doesn't have maturity. So the bank don't have to worry that when it's time to pay out the principal, they have to find ways of getting money, right? Because at the time during a crisis, they might have no way to borrow money because of all the liquidity crunch. Other banks uh, are afraid to lend out money and they are not able to do it, and in the end they have to go bankrupt, right? So by issuing perpetual bonds is one way of them to do it. So there are various uh, reasons for using perpetual bonds, what I'm trying to explain here. Okay, another thing is, despite having no maturity, perpetual bonds differ from equities as they have defined cash flows, no voting rights, and higher seniority in the capital structure. So the defined cash flow is the coupon payments. No voting rights because you are not a shareholder, you do not have a right to vote. And in case of any liquidation, you'll be uh, first in line. You have more priority in terms of getting back